The S&P on track for its best month since November of 2020, and the Nasdaq on pace for its best month since April of 2020. So a lot of momentum in this market, Joe. Why don't we just start with the action that we're seeing today? Is this a big deal? I mean, it seems like we're pulling back because oil's ticking a bit higher, and there's some questions about the Iran negotiations. But directionally, it seems like we're still on path for a very strong month.
Yeah, I think you're keeping your eye on oil, maybe paying a little bit more attention than you have in the last 2 weeks. We haven't been above $100 since April 13th. So that detail is in front of us right now and acts as a little bit of a headwind for the market. But I think overall, you're coming to the end of a month that, as you said, the best month for the S&P since November of 20. Rather impressive, the recovery that we're seeing in technology being led by semiconductors up 31%. Growth over value, once again, that's been the dominant factor force in the month of April. And here we go on the precipice of learning about the earnings for 5 of the mega caps. On Friday, Amazon finally reached that new all-time high that you and I discussed last Wednesday. I believe today Alphabet has achieved a new all-time high as well. NVIDIA very close to its October 29th all-time high. I think that intraday price somewhere around $212 and 20 cents. So I think 3 of them, Amazon, Alphabet, and ultimately NVIDIA, will achieve new all-time highs. I think human emotion, the natural inclination is to look at this, to move into the month of May, take the other side of it, say we're ready for a correction. My perspective is you just continue to ride the momentum, you risk manage the position accordingly, and you look for some paradigm shift in the market to signal to you that, in fact, that correction's coming. I don't see the evidence in front of me right now.
All right, you often point out the momentum in the market. By the way, Jenny, I want to come over to you. Wolf out with a note talking about momentum, saying that they are on the lookout for a reversal, and a 6 to 7% consolidation would not shock them. Are you focused on the momentum in the market? Or are you more looking ahead to Wednesday and even Thursday? We get Apple. So we have 5 out of the Mag 7 names reported this week. You're laughing.
Yeah, no, because you know me. I'm like the antithesis of a momentum investor.
That's why I brought it up.
I know.
That's why I brought it up.
But it's also funny when you're like, are you looking out to the next week? No, I look out to the next 3 years. But the reality is I'm a market junkie, and I hit refresh on my screen to see the performance every 2 minutes. So I do look out to next week. And where my head is at is a little closer to Wolf's. So I think the market's run back up, and it's been ignoring nuance. And what we're going to start to get this week and next week and the week after is we're going to start to get nuance in the conversation. And I think going back to the previous highs, going back to 50,000 on the Dow and 7,000 on the S&P, it basically says all clear. And it's not thinking about the fact that there will be aftershocks. I don't know how strong they'll be. I don't know if aftershocks from the closure of the Strait of Hormuz is going to show up in 1 month, 6 months, 12 months, probably all of the above. And so where I am is I think we have lower visibility. We're back at levels that we saw pre-Iran, but there's lower visibility. I think we're leaning more now towards inflation. When you have higher inflation, and I'm not saying high inflation, I'm just saying higher inflation, you don't deserve the same multiple that you get with lower inflation. So I think there's tricky stuff out there, and I don't know if a 6 or 7% pullback is right, and I'm certainly not saying bear market, but I think where you should be right now is you proceed with caution, you prepare for bumpiness, and you think with nuance. It doesn't seem like all's clear, even though the market valuation suggests it is.
Nuance is a great word. We've got, again, mega cap tech earnings coming up later. We got Microsoft, we got Amazon, we got Meta, we got Apple. Do you think investors are going to be looking for nuance in those reports, or is it simply about a beat and a raise?
So first of all, this is one of the biggest weeks that I can remember, honestly, in my career. We've got all of these mega cap earnings. SoFi also reports earnings on Wednesday, in case anybody wants that news flash. We have 5 central banks making a rate decision this week, covering all of the G7 countries. There's so much going on. The Senate Banking Committee is voting on Kevin Warsh, right? There's so much going on in this news flow that you can't ignore some of the nuances that will come out of it. Do I think there's going to be nuance in those earnings? Of course. I mean, the people that are going to pore over the differences between where revenue is coming from and what the outlook looks like. But I also think it's interesting that we're getting all of those mega cap earnings, except for Apple, which will come later. We're getting all of those mega cap earnings on the same day as the Fed. I would expect those companies to say glowing things about revenue expectations, CapEx expectations, and just guidance for the rest of the year. I don't think anything has changed. Where the nuance is coming in is that we had this huge V-shaped recovery after the market decided we were de-escalating the war, right? And a lot of things did go up. However, it is more narrowly led than it was pre-war. We don't have the same broadness that we had before the war. And I do think the market is again reliant on technology first and foremost, and a few other sectors, communications, consumer discretionary. And to Jenny's point, there will be some backlash later in the year as an oil shock works its way through, even if we have de-escalation now. So we still have to digest that later. And I also want to make sure that we remember we get GDP this week, we get PCE this week, and the Fed is likely to get a heads up of what that PCE number looks like before it even comes out. So there's a lot going on. I think inflationary continues to be the story. I think yields continue to be the story for the rest of the year. And again, to Jenny's point, multiples are going to have to digest this higher level of yields and perhaps even higher levels of yields as we hear more about how this bakes into inflation.
All right, Steve Weiss, coming over to you. By the way, Julian Emanuel out with a note saying the historically fast S&P 500 pivot off the March lows is only comparable to 1982. Going to lean on some of your experience. Do you see the comparisons to 1982? And what are you thinking about when it comes to these mega cap tech earnings?
You know, it doesn't matter if I see the similarity to 82, because the market's changed so much, it just doesn't matter. And if we're that easy to say, well, it was like this period back then managing money would be, easy, and it's not. So the market now has over 50%, close to 60% in passive funds. That was not the case back then, it was a fraction. And there's so many changes, the algo trading, et cetera. So I don't really think that's very instructive. Now, in terms of what's going on, Liz just listed a lot of events coming up this week. I think there are two critical events. One being, the Magnificent Seven, if you want to call them that, earnings, because clearly that's what's driven the market up. Everything's gone up in terms of their wake that supports their AI spending. And if they miss, it could be ugly. So, and then, of course, the stalemate. So if you go back and play this forward, when we first announced, the Iran excursion, the market took it hard and sold off. And then as we moved forward and we saw that there was light at the end of the tunnel, Iran and the U.S. sitting at the peace table, and then the market traded up. There are no negotiations going on right now, but the market's holding up. This little trade-off we're seeing today, meaningless in terms of where we've bounced to. So I don't know what the market's willing to bet on. I don't know what the market's willing to see. Truly, every opportunity since 2009, a V-shaped recovery and a buying opportunity. Corporate economy is pretty strong. The individual economy, well, that's feast or famine, right? People they're making choices because of the high price of oil. And then you get to the Fed, and you got to ask yourself, is there any case to cut right now? I don't see it, because you don't know what inflation's going to do. Even if you take out food and energy, inflation's still hanging out there at 3%. That's not where the Fed wants to see it go. If you lower rates when Warsh comes on, then you really got to ask yourself, you already damaged credibility of the Fed because of what Trump has been saying about the Fed. Is that going to remove confidence in the U.S. monetary system, or globally, because everybody invests on or bases everything off the dollar? So there are lots of crosswinds. Push comes to shove, I think you stay long because nothing seems to matter. The market just seems to want to go up.